Welcome to the Opening Bell Report.
Okay, let's just talk about the absolute chaos on the charts yesterday.
Right.
You look at the market one day, and the story around this one company is just all doom and gloom. It's their best days are behind them.
Everyone had written them off completely.
And they blink. You wake up, you check your portfolio, and that same stock hasn't just ticked up. It has erupted.
It's the kind of move that makes you wonder if the market has any clue what it's doing half the time. One minute it's a funeral, the next it's a parade.
Exactly. And we are talking, of course, about Coinbase, plus 16.46% in a single day, closing at $164.32. That's not just a move, that is a statement.
Oh, it's a massive statement. Especially for a company that big, you just don't see those kinds of double-digit jumps unless something fundamental has shifted.
Or unless the market realized it got something very, very wrong. And that's really what we need to get into today. Because the whiplash here is just, it's incredible. 48 hours ago, the street was acting like Coinbase was dead money. Today, the bulls are back in charge. But the mission for this deep dive is to figure out if this is actually real.
Right. Is this just a dead cat bounce, a temporary gasp of air before it sinks again?
Or are we looking at the start of a massive rally back towards that $200 mark?
That is the multi-billion-dollar question. And to get to the bottom of it, we're not just going off gut feelings. We've got a really solid market analysis report here that breaks down everything, the technicals, the fundamentals, even the competition, to find the real reason for this pump.
Okay, so let's start with the timing. Why now? The stock had been bleeding out for a while. What was the trigger that flipped the switch?
Well, the analysis basically suggests this was a perfect storm of technicals. You have to remember the context. The stock was aggressively oversold after that Q4 earnings miss. Sentiment was just terrible.
Right, the earnings came out, the market hated it, and everyone just slammed the sell button at the same time.
Precisely. It was a capitulation. But, in trading, when everyone sells, there's no one left to sell. The price got pushed down to this really critical level, around $140. The report identifies this as a huge historical support floor.
So is that just, like, the trading bots waking up? The algos?
In a way, yeah. I mean, when it hit $140, it triggered that classic buy-the-dip reflex. The risk-to-reward ratio suddenly looked way too good for traders to pass up.
It just got too cheap too fast.
Exactly. Simple mechanics.
Okay, so the technicals provided the spark. But a 16% move? I mean, that needs fuel. It needs a real narrative change. And I think I found the most shocking part of this whole analysis report. I actually had to double check the number because it just didn't look right for a crypto stock.
You're talking about the valuation?
The PE ratio.
Yeah.
The price to earnings.
It's the aha moment of the report, for sure.
I mean, for you listening, let's just set the stage here. Usually when you talk about these high-growth tech stocks, especially crypto, you expect sky-high valuations. You expect to pay a premium for that future growth. But this report puts Coinbase's PE ratio at 14.2x.
Which is, frankly, absurdly low for the sector.
14 times earnings is what you pay for a boring regional bank, or like a utility company that grows 2% a year.
Right.
You do not pay 14x for the leading U.S. crypto exchange.
Exactly. And to put that into some historical context, this report points out that Coin9 usually trades at a multiple of, say, 40 to 60 times earnings. That's the normal premium for being the leader in a high-growth, high-upside industry.
So at 14x, it was trading at a massive discount.
It was trading like a distressed asset. At 14x, Coinbase is currently cheaper than most of the legacy banks you just mentioned. The market had basically priced the stock as if the company were facing like an existential threat.
That implies the market thought they were going out of business.
Or that their growth was permanently zero. That's the theory the report puts forward. The market had priced in a catastrophe. And that 16% surge we just saw, that wasn't just momentum. That was the market collectively going, oops, we might have overcorrected.
It's a rubber band snapping back.
Correct. It's a realization that even if you have the most bearish case for the stock, a 14 PE for a dominant tech platform is just a mispricing.
But hold on, markets are usually pretty efficient. They don't price a stock down to 14x for no reason. There had to be some fear driving that. You mentioned existential threats. Let's talk about the elephant in the room.
The competition.
Specifically Robinhood.
Right. If you want to understand why the stock got beaten down to $140 in the first place, you have to look at what's going on with hate.
The analysis report is pretty blunt about this. It paints a picture of Robinhood just absolutely eating Coinbase's lunch on the retail side.
And they've got the hard data to back it up. This isn't just, anecdotal stuff. The report cites this really daunting statistic. Robinhood is growing its crypto revenue by 490%.
490%.
Yeah.
That's staggering.
It's nearly 500%. That proves pretty definitively that the retail trader, the person buying $50 of a meme coin on their lunch break, is migrating. They're going to Robinhood.
Well, it makes sense from a user perspective, right? If I already have Robinhood for my stocks, why would I open a whole separate Coinbase app and pay higher fees? It's just friction.
That's it exactly. It's the super app idea. Robinhood is becoming the one-stop shop. And for a long time, the market looked at that 490% growth number and just thought, well, that's it. Coinbase is losing its base. They're the MySpace to Robinhood's Facebook.
And that's why we got the sell-off and the low PE.
Right. But, and this is a really big but, the report offers a bull rebuttal. And judging by yesterday's stock price, the market is starting to listen.
Okay, so what is the defense? If Robinhood is winning the retail war, what does Coinbase even have left?
The pivot. The report argues that while Robinhood is fighting for the retail crumbs, Coinbase has successfully pivoted to what it calls institutional dominance.
Okay, so they're basically conceding the small fish to catch the whales.
It's a move from B2C to B2B. Think about the actual infrastructure of the financial system. We're not talking about day traders anymore. We are talking about BlackRock. We're talking about Fidelity. We're talking about the plumbing.
You mean things like the ETFs?
Exactly. When those massive Bitcoin ETFs launched, who did all the issuers choose to actually hold the Bitcoin? Who is the custodian?
Coinbase custody?
Almost all of them. And then you look at the base blockchain they're building out. The report's theory is that this current rally is likely institutional money betting on that infrastructure play. It's like, let Robinhood handle the gamified retail trading. We're going to own the rails that move billions for the banks.
That's a much stickier business model, isn't it? Retail traders are fickle, they churn. But if you're the custodian for a BlackRock ETF, that's a long-term contract.
It's a high moat. It's much harder to disrupt.
Yeah.
So even if Robinhood has more users, Coinbase might be processing way more value.
It's the difference between owning the toll booth and owning the highway itself.
That's a great analogy. And it seems like the market is finally deciding that the highway is worth a lot more than a 14x PE, even if the toll booth traffic is a little slow.
Okay, I buy that narrative. We are the infrastructure. It sounds good. But let's look under the hood a bit at the actual financial health, because the report seems to be a bit of a good news, bad news situation here.
It really is. And honestly, this is where the skeptical investor needs to pay close attention. Because the headline numbers look fantastic, but the details are a bit concerning.
Let's start with the good news, the fortress. The report calls their core business a fortress.
And it is. They highlight a gross profit of $3.90 billion.
Almost $4 billion. That is not a small business.
No, it's massive. That top-line revenue generation is incredibly strong. It shows that despite all the competition, they are still generating huge amounts of value.
So if they're bringing in nearly $4 billion in gross profit, they must just be printing cash, right?
You'd think so. But this is where the analysis in the report kind of throws a wet blanket on the party. You have to look at the free cash flow.
The actual money that ends up in the bank account at the end of the day.
Right, because after you pay your developers, your marketing, your executives, all that stuff, the free cash flow margin is only 4.2% of sales.
Wait, 4.2%?
4.2%.
So for every dollar in sales, they're only keeping 4 cents.
Essentially, yeah. It's razor thin.
How is that even possible for a tech company? Usually, software margins are beautiful. Where is all the money going?
Well, the report points to the brew factor. It's two main things. R&D, building that infrastructure we just talked about, and stock-based compensation.
Ah, the silent killer of tech stock.
It's huge. They pay their engineers and talent heavily in stock. That keeps cash in the company, technically, but it dilutes the existing shareholders. It's an expense that just crushes that free cash flow number.
So the fortress has a leak.
A pretty big one. And analysis gives a really tough comparison here. It says if Coinbase wants to be treated like a mature financial exchange, they need to look at a company like the CME Group.
The Chicago Mercantile Exchange.
The gold standard. CME Group boasts margins of around 63%.
63% versus 4.2%.
That is the gap. It's the difference between a mature, optimized financial machine and a growth company that's still burning cash to build.
That is a massive canyon to cross. So bring this back to the surge. The stock jumped 16% despite this cash flow problem.
Yes, and that tells us everything we need to know about the market's mood right now. Investors are ignoring the fundamentals, like that weak cash flow, and they're focusing entirely on momentum and the narrative.
They're betting that the 4% margin eventually turns into 60%.
Exactly. They are buying the dream, not the current reality. But, and this is so crucial, momentum is great until it stops. If you're buying a company with 4% margins, you're taking on a lot of risk. There's no safety net of cash generation to fall back on.
Which brings us perfectly to the tactical side. If you're listening and you're holding COIN, or maybe you're tempted to jump in, what does the report say needs to happen next?
The analysis is very specific about the price levels to watch. This isn't a buy and forget about it recommendation. It's a tactical trade.
Okay, so we closed around $164. What's the very next test?
The immediate hurdle is the post-market high. The stock needs to break $168 to confirm this isn't just a one-day wonder.
So $168 is the confirmation signal.
Yes. If it gets rejected there and rolls over, you need to be careful. But if it breaks through $168 with some volume, the report says the next major resistance, the next big fight, is up at $185.
That would be another big leg up from here.
It would, but you have to look at the downside too. The report is adamant about one number.
On 50.
That's the floor. It is absolutely critical that the stock holds above $150. Remember, the whole breakout started from that $140 base. If it drops back below $150, the report basically suggests this entire 16% surge was a fake out, a bull trap.
So the buy the dip crowd from $140 needs to defend the line at $150.
Exactly. If $150 fails, the whole narrative collapses, and we probably go right back to the Coinbase is dead story.
But there's a big external factor here too, isn't there? We can't analyze Coinbase in a vacuum. It's not just about their PB. It's about the assets they serve.
The Bitcoin factor. You just cannot ignore it. The report really emphasizes that Coin on stock acts as a leveraged bet on Bitcoin.
The high beta play.
Right. So if Bitcoin runs, say it goes up 5%, Coinbase tends to amplify that. It might go up 10%, maybe 15%. But that leverage cuts both ways.
So if Bitcoin sneezes,
Coinbase catches pneumonia. Even if the chart for Coin looks perfect, even if it breaks 168 grand, if Bitcoin suddenly dumps 5 grand, Coinbase is going down with it. The correlation is just incredibly high.
so you have to watch two charts at once. You're watching the 150 and 168 levels on Coin, but you're also keeping one eye on the crypto market as a whole.
They're inextricably linked. You're betting on the crypto economy as much as you are on the company.
So let's wrap this up. What's the verdict? The report lays out the good, the bad, and the levels to watch. What is their final call?
The verdict is a cautious buy.
Caution.
They recognize the opportunity. That 14x PE is just too cheap to ignore for a market leader. The upside to $200 is real, but they can't go to a strong buy because of that volatility and the margin issues.
It's not a mortgage the house kind of trade.
Definitely not. It's a take a position, but keep your finger on the sell button trade. It's high risk, high reward.
Okay, so let's recap the main takeaways for everyone listening before we sign off.
Sure. Number one, the surge was a technical rebound fueled by the realization that a 14x PE was just too low.
Number two, the narrative war. Robinhood is winning the retail battle, but Coinbase is trying to dig a moat around the big institutional money. The infrastructure play.
Number three, the financials are a mixed bag. A fortress of revenue, but it's leaking cash. They're nowhere near as efficient as, say, a CME group. Not yet.
And finally, watch the levels. $168 is the breakout, $150 is the trap door.
Okay.
And don't you dare forget to watch Bitcoin. You know, this whole deep dive really highlights something bigger than just one stock. We're watching the market struggle in real time to figure out how to even value this new world.
We really are. It's a collision of old school metrics and new school assets.
And that leads to a provocative thought I want to leave you with. We spent a lot of time talking about that PE ratio, comparing Coinbase to banks, their margins to the CME group.
The traditional benchmarks.
Right. But if that infrastructure thesis is true, if Coinbase is really becoming the plumbing, the rails for the future of finance, does a PE ratio even make sense anymore?
That's the deep question, isn't it?
I mean, when Amazon was building out AWS, for years they showed zero profit. Their PE was infinity. And the people who focused on that missed the biggest growth story of the century.
Because they were trying to measure a digital network with an analog ruler.
Exactly. So if Coinbase is selling access to the future, maybe looking at last quarter's free cash flow is looking through the wrong end of the telescope. Maybe we need a whole new metric to measure the value of the rails.
It's possible. Maybe it's price to network value or price to assets on platform that matters more than earnings right now. If they win the infrastructure war, the earnings will follow. But if you wait for the earnings to show up, you might have already missed the move.
Yeah, it is definitely something to chew on. Are we all valuing a rocket ship like it's a railroad?
Only time will tell. But for now, I'm watching that $150 level like a hawk.
Same here. Thanks for diving deep with us today. Hopefully your portfolio is a little less confusing than it was 20 minutes ago.
Always a pleasure.
We'll catch you on the next deep dive. Keep your eyes on the charts.
Don't forget to like, share, and subscribe for more.